Okay, next up, disposing of a plant asset. All right, you don't need to know journal entries. But do need to know how to calculate gains and losses. Okay, so we're going to talk a little bit about journal entries, but you don't actually have to know them. All right, now, sometimes what happens, when you've used up an asset and you don't need it any longer, you can either just, take it to the dump and throw it away. You can sell it, or you can exchange it for another asset. All right, no matter which one you do, there are a couple things that you have to do. All right, so before getting rid of, however you're going to get rid of it, before getting rid of a plant asset, you need to record depreciation to that date. If it is not fully depreciated. All right, a lot of times it's going to be fully depreciated and you wouldn't have to worry about it. But if it's not fully depreciated, then you need to do that. All right, then what has to happen is when you get rid of it, you have to take the accumulated, well, let's assume we're selling it. That we're selling an asset for $1,000, has a cost of $10,000 and accumulated depreciation of $8,000. Okay. So we're getting the cash of $1,000. We have to take off the accumulated. Accumulated depreciation has a credit balance, so we have to debit to get it off. All right. Then we need to take off the asset, whatever it may be. I don't know what it is, but anyway, cost us $10,000. It has a debit balance, so it's a credit to take it off. And then if you notice here, I've got I have $9,000 on this side, and I have $10,000 on this side. I'm sorry. All right, I'm off by $1,000, and it needs to be on this debit side. So I need to move this down. Usually I skip a line. Should have this time too. I need another $1,000 here to make it balance out. And since it's on the debit side, that is a loss on disposal. Okay. You do not need to know how to do the journal entry. What I want you to know is how to tell me if it had a gain or a loss. So to calculate, you look at the sale price minus book value, and that gives you the gain or loss. All right, so in our case, I sold it for $1,000. Its book value is $9,000. So if you do the 1,000 minus the 9, I'm sorry, it's not 9, it's 2. Its book value is 2,000. Then I have a $1,000 loss. Okay, and then remember, by now you should know what book value is. All right, book value, this is cost minus accumulated depreciation. So for us, it was 10,000 minus 8,000. Okay? And that's the main thing you need to know. When you're actually doing journal entries, and like I said, we'll do this, if you're an accounting major, we'll do this in intermediate accounting, but you have to take the asset off the books and any related accumulated depreciation. So you'll always have these two items in your entry, and then other stuff will fill in around it. Okay, another thing that they talk about a little bit in this chapter are natural resources. Oh, and we're not going to do any numbers with it, but natural resources refer to items that we take out of the land, out of or off of the land. So this might be oil and gas, minerals, iron ore, timber, coal, anything like that. Okay. So when we do this, depletion is used to write off the cost of these assets. Used as units of output. Generally, like we think we're going to get 1 million barrels of oil, and we use that to deplete it. Okay. And we'll also do more of this in intermediate accounting. All right, let's see what else is in here. Oh, we have a little bit on intangible assets. All right, intangible assets. All right, these are generally, you can't really see them. It's more of a legal document or rights. All right, so for instance, if I develop a new type of screwdriver or wrench to work on a truck motor, then I might want to get a patent on that. Okay, so in those type of things have patents, and I would actually, it didn't cost me much to develop it, but if I take a patent on my invention, then nobody else can make it or sell it until the patent runs out. All right, so patents usually have a life, I think, of 20 years. And then nobody else can make it and sell it until the 20 years are up. All right, a copyright applies to works of art or literature, things like that. Music, works of art, books, things of that nature. And they usually have a life of creator plus 70 years. So I can't use it without permission until that time frame is up. All right, a trademark is like a logo. It has an unlimited life, I'm pretty sure. And it's usually developed through advertising. Which is expensed. So this would be things like McDonald's arches, the Nike swoosh, Polo, Adidas. I don't know if I'm spelling Adidas right, but anyway, I know it. No, that's not right. I think one of them is 2 Ds, but I don't remember which one. And so on and so forth. Those are all trademarks. They're usually developed through advertising, and we don't know if it's going to benefit us in the future, so we expense that as we're doing it. But I have to file for the trademark on something, and then I have a little bit of a legal document that has it. Now, if I want to buy the Nike swoosh, then I'm going to have to spend a whole lot of money, and I would have a huge amount on my balance sheet for that. Okay. Intangible assets are amortized. All right, intangible assets are generally amortized over their life. Once again, we're not going to do it. You just need to know the terms. Okay, so they go a little bit more into it. We're not doing all that. You don't need to know all that. I just want you to know the definition of a trademark. If you are an accounting major, we'll get it again in intermediate. I do want to talk a little bit about goodwill, though. Goodwill is another one. Goodwill can only be purchased and it's basically when you pay more for another business than its fair value. All right, so I don't know if y'all are familiar with King's Inn. It's a restaurant down by where I live, and it's very old. All right, it's an old dance hall. It's been there, for all the 1900s. It's probably 100 years old. It is sitting on some property that's probably worth a little bit of money, but I'm sure that everything in the King's Inn, like the building, the equipment, everything has been fully depreciated. All right, bathrooms haven't probably ever been updated. Maybe when they got indoor toilets, they were updated, but probably not since then. All right, so the fair value of King's Inn, let's say, is $1 million, okay? And most that's going to be the land that it's sitting on, not necessarily the building. However, the owner wants to sell it for $3 million. Okay, that difference, that $3 million that he wants for the sales price, minus the $1 million fair value, that is goodwill. You're paying for the reputation of the King's Inn. Okay? That is an intangible asset. You can't really see it, and it only would show up when I buy another business. Like, the owner of King's Inn can't just randomly slap $2 million of goodwill on his balance sheet. His will always just be at cost. But if I buy King's Inn, I'm going to have something on my balance sheet for goodwill. And it would stay on my balance sheet forever or until I don't have it anymore. And by not have it, I mean that I haven't run the business in such a way that it's not worth that anymore. Okay? So that's goodwill. And I think we're done with the chapter. Well, you have the asset turnover. Y'all can look at that. And we're not doing exchanges. You can skip that. Okay? All right. That's it. I will go work some exercises for y'all to follow when you're trying to get the homework done.